Good evening, ladies and gentlemen, and thank you for attending our 2012 stock market briefing. So the title of my report for today is Strong and Sustainable Uptrend. Okay, so just a recap of what has happened for the first 3 months. So for the year-to-date period, the market, or the PSEI, is up by 17.7%. However, it's not the only stock market that is up globally. In fact, all stock markets globally are up. MSCI World Market, or the index that measures the performance of the world market, is up by 12.2% for the year-to-date period. And I guess a lot of you are here today because you're wondering whether this is, what's happening is an insanity or if this is sustainable. Okay, just a recap of what has happened in 2011. I think you will better appreciate why we are performing, or the stock market is performing so strongly today by knowing what has happened in 2011. So in 2011, if you can recall, the major concern was a potential default in Greece and the implications on liquidity. There were concerns that there was going to be a repeat of Lehman Brothers crisis. And aside from that, there would be a contagion in Europe. So here, I'd like to show you the CDS. CDS, by the way, is measure of insurance against defaults. So as you can see here, the CDS for both Spain and Italy, which does not have the same problems as Greece or are not in a position to default, you can see that the CDS of these two countries late last year also went up due to concerns that they may encounter problems resulting from a potential Greek default. And aside from that, last year, people were so concerned about preserving capital. So here you can see the orange line, which represents T-bond rates. So the 30-year T-bond last year was actually up by 19%. This was despite the fact that T-bond rates in the US are already very low. T-bond rates continued to drop last year, despite this, and this is despite the downgrade of the US credit rating. In contrast, the global stock market was down by 10% on the average last year. So in summary, last year, people were just focused on preserving capital. Therefore, they shifted funds away from risky assets such as stocks to safe havens such as US Treasuries. Okay, so what has changed in 2012? Well, first of all, Europe. Well, the European Central Bank came out with a 490 billion euro 3-year cheap loans, and they extended this to banks. So these loans are only, the 3-year loans only cost the bank 1%. So it effectively addressed the liquidity risk that people were concerned about during the fourth quarter. And then the US came out with better than expected economic indicators, such as better than expected unemployment numbers, higher than expected job creation, and pickup in manufacturing. And then in the Philippines, okay, remember last year a lot of people were getting impatient with the government. However, late last year or last December, the government finally awarded its first PPP, the Daang Hari project, and then it was able to pass the 2012 budget on time. And then S&P announced that they have upgraded the ratings outlook for the Philippines. So all these acted as catalysts for the stock market in 2012. Going forward, we believe that the long-term outlook remains positive, and the main drivers would be low interest rates and the shift of attention from developed markets to developing markets. So I'll talk about this one by one. Okay, I think one of the reasons why all of you are here is because of low interest rates. Well, obviously, you can see here the 10-year interest rate. From around 17.62%, it's now down to 5.8%. Okay, so clearly interest rates are on a downtrend. And we think that this will continue, or rates will remain low. Okay, and this is because of ample liquidity due to easy monetary policy globally and increasing likelihood that the Philippines will have an upgrade. Okay, so this is, I've provided a table here to show you what has happened globally as far as monetary easing is concerned. Okay, so you can see not only are interest rates falling in the Philippines, they're going down everywhere else in the world. So last December, Europe started out with the bailout, the 490 billion euro bailout, or the cheap money. Then in January, our Banco Central cut interest rates by 25 basis points, and the US pledged that they will keep interest rates low, and they extended it from 2013 to 2014. And then in February, you have Bank of Japan adding 10 trillion yen to their 20 trillion yen pool of funds set aside to buy government bonds. Now, if you buy government bonds, that will really lead to lower rates because that will reduce the supply of bonds available for people to buy. Okay, then China cut reserve requirements by 50 basis points. Okay, Bank of England increased its asset purchase program by 50 billion to 325 billion. The list goes on. For February, you have Indonesia also cutting rates by 25 basis points. The European Central Bank again extended another 529.5 billion euros worth of cheap funding, 3-year funding to banks, to 800 banks this time from around 500 previously. And then for March, you have Banco Central cutting rates again by another 25 basis points. Then you have Brazil cutting rates by 75 basis points. So globally, you see central banks cutting rates or taking steps to increase liquidity. So this will definitely keep interest rates low globally. And as far as government is concerned, its finances are improving. So as you can see here, government revenues are picking up again, and then the deficit to GDP was actually falling. Well, it picked up in 2009-2010, but it has actually gone down again. And then debt to GDP is going down. Bottom line, it just goes to show that the government now has more money and is less dependent on debts. And then this one is very important. If you look at the remittances, current account, GIR, and GIR to external debt, the point is you can see that the GIR is picking up, or the gross international reserve. So the government has a lot of dollars in its books. And the current account is being strongly financed by remittances, which later on I will show you is very resilient, or it doesn't really go down. So in that respect, focus on the last column, which shows GIR to external debt. So previously, we did not have a lot of US dollars, or the central bank did not have a lot of US dollars in its balance sheet. But if you look at the 2011 number, it's now more than the amount of external debts that we have. And in fact, the Philippines is now a lender in the international market because we have more dollars than we owe the international market. So that would imply that we are very strong, and the source of our dollars is remittances, which have been very resilient and are expected to remain resilient going forward. Okay, so we have already seen a lot of ratings upgrades taking place. And last December, S&P upgraded the ratings outlook from stable to positive. And just this March, Moody's hinted that they will upgrade the Philippines' credit rating. Okay, and the reason why low interest rates are important for stocks is because stocks are now a viable or a strong alternative to bonds. So this chart shows you the difference between stock earnings yield and bond yields. So stock earnings yield is the ratio of earnings over price. Okay. At this point in time, there are periods where the earnings or the yield that you will get by investing in stocks are actually higher than the returns you get from investing in bonds. So if the returns on stocks are superior compared to returns in bonds, definitely there will be a shift from fixed income to stocks. So that's one of the reasons why the market is strong, because we're seeing that shift in funds from fixed income to stocks. And aside from that, I'd like to highlight that in the Philippines, there's a very, very small investor base. So in the Philippines, less than 1% of the population is invested in the stock market. Okay, in contrast, you have Thailand. Well, Thailand is still low, 1%. But it can go as high as 35%, 43%, and 50% in other more developed economies. So there is really much room for investor participation to increase. Okay, well, in the past, I've done some presentations on the stock market, and one of the major concerns that have been raised were concerns about Europe. Like, Europe is still going to have problems. We don't want to invest because we're concerned that there will be another crisis, so on and so forth. So in light of that, I just like to highlight that the reason why funds are flocking to the Philippines is because there is a shift from developed to developing economies such as the Philippines. Okay, and the reason why this is happening is because the Philippines has a relatively attractive fundamental compared to the developed economies. So this is because, first, we don't have the same structural problems facing the developed economies. Okay, we have a strong banking system, and there's room for investment spending to grow. The government is also set to increase its pump priming activities. And finally, we have shown resiliency to external shocks. So I'll talk about this one by one. Okay, what are the structural problems in the developed economies such as Europe and US? Okay, first, they have an aging population. Okay, later I will show you the data. But if your population is aging, clearly, they will not spend money, they will not work. Okay, so that will negatively affect consumer spending. And aside from that, the government has to spend money on them, okay, for Medicare and other things like that. Okay, then you have highly leveraged consumers. Obviously, if your consumers are highly leveraged, they have to think about, when they think about saving money, then they will not spend. That's bad for consumer spending. Next, they have a highly leveraged government. So obviously, if your government is highly leveraged, they cannot afford to support you as well. Maybe they have to increase taxes. Okay, so those are the negatives of developed economies. Okay, so here are the data showing what's going on in developed economies and what's going on in the Philippines. So as you can see here, clearly we don't have the same problems. For example, percentage of population greater than 65 years old. Okay, US 13%, Europe 18%, Japan 22%. In the Philippines, it's only 4.3%. Average age is half of those of the other economies. And then household debt to disposable income. So as you can see, in the developed economies, it's almost 100% or more than 100%. But in the Philippines, it's only 9%. And then government, as you can see, is highly leveraged for the developed economies. In the Philippines, it's expected to be at 49.4% only. Okay? And deficits, well, the Philippines has a deficit, but it's only 2%. The other economies have very huge deficits that they have to address. Okay, and then another important point is the banks. Banks are very important because they will help fund consumer spending, they help fund growth in investments. So in the Philippines, you can see the banks are very strong. On the right-hand side, you can see the non-performing loans ratios are falling. And then at the same time, banks have more than enough provisions to cover the non-performing loans that are still in their books. Okay, at the same, and I think most importantly, the capital adequacy ratio is very high. So, the banks, as of the third quarter of 2011, had a capital adequacy of 17%. Now, if you read the newspapers every day, you will read about implementation of Basel III. And then they talk about implementation of Basel III in 2019. However, recall that the central bank is very confident about meeting this Basel III requirement and is pushing for an early adoption by 2014. And we're actually not surprised because, as you can see, the capital adequacy of our bank is already 17%. The Basel III requirement is only 10.5%, so our banks can meet this easily without any problems. In contrast, the banks in Europe and the US have a lot of problems and are having a difficult time meeting this. Therefore, they really need that much time to comply with the 10.5% minimum requirement. Okay, aside from that, the Philippines has room to increase investment spending. So this chart shows you the size of investments relative to GDP. So investments to GDP in the Philippines is only at 22%. In contrast, you can look at other developing economies. They are really much higher, okay, except for Malaysia. So it just goes to show you that there's room to increase investment spending in the Philippines because we are really very underinvested. And well, my favorite example would be EDSA. I mean, every day you pass through EDSA, and I think if there was a new road as an alternative to EDSA, even if they charged you maybe 50 to 100 pesos, you'd probably use it because of the traffic that's taking place in EDSA. Okay, so really there is room to increase investment spending in the country. And then the government, well, it's finally showing signs that they are on their way to increase spending. Okay, so what are their plans for 2012? The plan is to increase spending by 18%. And on top, they recognize that infrastructure is a very important spending. They plan to increase capital outlay by 24.3%. And then 72% of the funds allocated for this have already been released. So this is in contrast to 2011, where the government underspent. Now they're trying to catch up and increase spending. And then for 2012, they said they will roll out 17 PPP projects. Okay, the 15 of which have a combined value of 196.8 billion, or this is equivalent to 4.6 billion US dollars. So clearly the government is showing signs that it's getting its act together, and we're quite positive and excited about this. So other countries, the government of other countries or the developed economies cannot increase spending. They have to think about austerity. In the Philippines, the government has room to increase spending. So that's very positive for the economy and the stock market. And finally, I think we go back to the concerns about the Philippines being vulnerable to developments externally. Admittedly, exports have not been strong last year. They were hit by developments in Europe. But I'd like to point out our other strong points. If you look at the OFW remittances, focus on the years 07, 08, where we had the US financial crisis, or the global financial crisis for that matter. Despite concerns that OFW remittances would go down, they continued to pick up. For the first month of 2012, OFW remittances still went up by 5.4%. And the target for this year is actually for the remittances to grow by 5%. And then BPO revenues remain resilient. So again, despite the financial crisis globally, you can see here that BPO revenues continue to go up. I think the main reason why companies continue to relocate to the Philippines is because of the relatively cheap labor cost and the need to cut costs in US and Europe, okay, given the difficult times there. Okay. despite our positive long-term outlook for the Philippines, we believe there are some short-term risks. Okay. To a certain degree, we believe that prices have run ahead of fundamentals. This is because market is currently up by almost 18%, whereas our earnings forecast for 2012 is only up by 15%. Okay. So recently, companies came out with their 2011 earnings results, and based on what we see, we don't think there is much room for earnings upgrades. And then finally, a lot of the stocks are trading close to our fair value estimates, and in fact, our fair value estimates are already above the consensus estimates at this point in time. And finally, we are a little bit concerned about the negative impact of rising oil prices on economic growth. Okay, so here is a sample of, based or 20-something companies that have come out with 2011 earnings. So we did a table, we tabbed how they performed relative to our forecasts. Okay, so relative to our forecast, around 30% delivered inline results, 26% performed better than expected, but you can see that a big portion of these companies delivered worse than expected results. So in light of this, we don't think there's a lot of analysts will be raising their 2012 earnings forecast for the companies. Okay, earlier this year, we actually increased our fair value estimates for the stocks for a lot of stocks, after factoring in much lower interest rates. However, despite this, after 3 months of a strong performance for the stock market, you can see that around 70% around 60 to 70% have minimal upside already to the share price. Only around 35% can still provide an upside greater than 15%. So a lot of stocks are already trading close to fair value. Okay, and another concern would be oil prices. So as you can see here, oil prices are up by 9.4% for the year-to-date period, but are already close to where they were sometime or middle of last year. So our concern here is that this could dampen consumer spending, given that oil accounts for around 8% of an average Filipino's spending, and the secondary effects it would have on them. So we're just concerned that this could provide some negative shocks or negative surprises as far as economic growth is concerned. Okay, so our strategy for the market, despite this short-term weakness, is to stay invested, because I think the focus really should be much longer term. But let us manage our risk by buying a diversified basket of stocks, not only focusing on one stock, and buying only stocks that remain cheap. Okay, we believe there will be opportunities to buy stocks at cheaper prices. Okay, and if prices pull back, investors should look at buying stocks or be prepared to buy stocks. So we think there will be 3 themes that will outperform the market this year. And the 3 themes are growth, dividends, and small cap value. Okay. So here are the stocks in our model portfolio. Actually, if you've been reading or if you've been following our research, early this year we came out with a new product named Calling the Shots. So it's a monthly strategy piece talking about our views of the market. And in the last portion, we come out with a model portfolio. Okay, so we launched this product first week of January, and we came out with the list. So our initial list was the first 8 stocks. And the first 8 stocks, if you had bought them during the start of the year, would have yielded you a return of 23.3%, which is around 6 percentage points higher than the return of the market. Okay. Unfortunately, a lot of them have increased, or the price of a lot of these stocks have increased significantly. So we are putting a buy below price here so that you will be prepared to buy these stocks in case they pull back in price. So the first set of stocks we have here are growth stocks. We think they will benefit from the Philippines' positive long-term growth outlook. Okay, you have Metro Bank, which is a bank. Then the infrastructure plays, which are MPI, Ayala Corp. We believe AGI will be a beneficiary of booming tourism in the Philippines. And then Ayala Land, obviously, is properties tend to benefit from strong economic growth in economies. Then we have dividend plays. We think with very low interest rates, there will be a shift, or a lot of investors who are new in the stock market would actually want to go to high dividend yielding stocks. Okay, so these are high dividend yielding stocks with minimal downside risk in terms of share price. So we have BPI, Robinson's Land, Manila Water. And then given that a lot of stocks now are quite expensive, we think there will be rotation in smaller cap stocks or small cap value stocks. So in our list, we see 3 small cap stocks that are still trading at attractive values. They are Philinvest, Megaworld, EEI. So these 3 stocks actually are trading at below 10 times PE. And for Philinvest and Megaworld, these 2 stocks are trading below 1 times price to book value. So these are very, very cheap stocks, and we think we might see some funds shifting into these value stocks given that the larger cap active stocks are already a bit pricey. Okay, so in summary, we believe that the Philippines is in a long-term uptrend driven by low interest rates and the country's attractive fundamentals relative to developed economies. However, a correction could take place in the short term, given the market's sharp rise for the year-to-date period, lack of catalyst for earnings upgrades in the short term, and the possible downside risk on economic growth brought about by rising oil prices. Okay, we expect 3 themes to outperform in 2012. They are growth, dividends, and small cap value. Among the stocks on our list, Metro Bank, Robinson's Land, Manila Water, Philinvest, Megaworld, and EEI can still be bought since they continue to trade at attractive values. Meanwhile, wait for pullbacks to buy Ayala Land, Metro Pacific, Ayala Corp, AGI, and BPI. Thank you very much. That ends my presentation.